Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Yeah.
Buckle up.
Oh,
It's
yeah.
been a wild ride these last few days
Absolutely.
with President Trump back in the Oval Office.
It's like someone hit the fast forward button on market volatility.
Exactly. And we've got a stack of articles here.
Oh, yeah.
Barron's Bloomberg Market Watch,
Uh-huh.
the Wall Street Journal, CNBC,
Yep.
all trying to make sense of it. Today, we're going to break it all down for you, focusing on how markets are reacting to Trump 2.0 and what you need to know to navigate your own portfolio through this turbulence.
And maybe even spot some opportunities amidst the chaos.
Definitely. So Barron's threw me a curveball. Right off the bat, they're talking about how Warren Buffett, the ultimate buy and hold guru,
Right.
is actually sitting on a mountain of cash right now. Not bonds, but cash. It's got to make you wonder, right?
It certainly challenges the conventional wisdom, doesn't it?
It does.
But when you look at the specifics of Berkshire Hathaway, as Barron's does, it starts to make more sense. They have massive insurance liabilities, so Buffett needs that cash on hand for potential claims. It's his safety net.
So it's not necessarily a sign that he's bearish on the market overall. It's more about his unique situation.
Exactly. But it does raise the question for the rest of us, how should we be thinking about bonds versus cash in this environment, especially with all this interest rate volatility we've been seeing?
That's what I was going to ask next.
Hmm.
Barron's did some analysis using Vanguard funds as examples, and it's pretty eye-opening in 2022 when the Fed started hiking rates aggressively. The Vanguard long-term Treasury fund tanked down a full 30%.
Yeah.
Meanwhile, their money market fund actually gained 1.6%.
Yeah, that really illustrates the inverse relationship between interest rates and bond prices. When rates go up, bond values go down, especially for those longer-term bonds.
So for short-term needs, cash seems like the clear winner. But what about for building long-term wealth? Should we follow Buffett's lead and just hoard cash?
Well, Barron's quotes William Bernstein, the author of The Four Pillars of Investing, who suggests a different approach. He's recommending a ladder of Treasury inflation-protected securities, or TIPS, for retirees. And for those of us still working, he actually favors a mix of stocks and cash instead of the traditional stocks and bonds portfolio.
Interesting why the shift away from bonds.
He argues that having a cash cushion makes investors less likely to panic sell their stocks during market downturns. It provides a sense of security, which can lead to better long-term outcomes.
I see his point. It's like having that emergency fund you always hear about, only it's specifically to prevent you from making emotional investment decisions.
Exactly, and he's not alone in this thinking. Christine Benz from Morningstar also emphasizes the importance of a cash reserve, especially in times of economic uncertainty.
So there's no one-size-fits-all answer when it comes to bonds versus cash. It really depends on your individual goals and risk tolerance.
Exactly. And
All right.
speaking of risk, let's talk about the elephant in the room, Trump's tariff plans. Bloomberg dropped a bombshell yesterday reporting that he's considering slapping 25% tariffs on imports from Canada and Mexico, and not gradually either. We could be talking February 1st.
Whoa, that's a lot sooner than anyone was anticipating. I thought those new tariffs were supposed to be phased in more slowly.
Right, the earlier reports suggested a more measured approach, but this news from Bloomberg really throws a wrench into things, and the markets reacted immediately. Both the Canadian and Mexican currencies took a hit while the U.S. dollar rebounded.
It's like a flashback to the trade war days.
There's definitely a sense of déjà vu, and it's not just North America feeling the tremors. CNBC and MarketWatch are both reporting on the uncertainty rippling through European markets. Car makers in particular are bracing for impact.
I bet they rely heavily on cross-border supply chains.
Yeah,
Any disruption in trade flows is going to hit them hard.
absolutely. But here's a curious twist. The Wall Street Journal is reporting that some investors are actually breathing a sigh of relief.
Relieved how so?
Well, during the campaign, Trump was hinting at these sweeping global tariffs that had everyone on edge. So these targeted tariffs, while still disruptive, are at least not as widespread as some feared. It's a case of better than we thought, even if the news is still bad.
Right. It could have been worse, but still, it's a gamble. And speaking of gambles, the WSJ also mentioned the ZEW indicator of economic sentiment, which measures German business confidence. And guess what? It just took a dip.
Oh, yeah. That's significant because Germany is Europe's economic powerhouse. Their confidence or lack thereof is a bellwether for the entire region, and this dip suggests that they're worried about both U.S. trade policy and the upcoming elections in Germany.
So it's a double whammy of uncertainty for them.
Exactly. But amidst all the doom and gloom, there are some potential upsides that a few sources are pointing to.
Oh, like what?
Well, CNBC mentioned the possibility of deregulation and tax cuts, which are classic Trumpian moves. The thinking is that these might offset the negative impact of tariffs, at least to some extent.
It's a bit of a wait-and-see situation.
Definitely. And investors are weighing the potential benefits against the very real risks.
So let's bring it back to our listeners. What does all this mean for their portfolios? How do they navigate this turbulent landscape?
First, it's crucial to remember that short-term needs should always be kept in cash. That's your emergency fund, your down payment savings, anything you might need access to in the next few years. Barron's really hammered that point home for longer-term goals. Diversification is key. We've talked about the different approaches, stocks and bonds, stocks and cash. It really depends on your individual risk tolerance and how comfortable you are with volatility.
And let's not forget about taxes. The Barron's article about Roth conversions really got me thinking. With the potential for future tax increases, converting traditional IRA assets to a Roth IRA now might be a savvy move.
That's an excellent point. It's all about anticipating the future tax landscape and making moves that minimize your liability, but it's a complex decision. So definitely consult with a financial advisor before making any big moves.
Right, professional advice is never a bad idea, especially in times like these. But before we get too deep into tax strategies, we need to talk about another major market factor that's been making headlines, the Bank of Japan.
Ah, yes. The WSJ had a fascinating article about their potential rate hike, and it's a delicate situation.
They're walking a tightrope, trying to balance domestic economic goals with all the global uncertainty swirling around them.
Exactly. And speaking of uncertainty, the biggest wild card in their decision-making process is, you guessed it, President Trump.
His every move, from tariffs to immigration policies, has the potential to send shockwaves through global markets.
Right, and the Bank of Japan is watching very closely.
It's almost like a high-stakes poker game with everyone trying to anticipate the other player's next move. But before we dive deeper into that, let's take a quick break to gather our thoughts. We'll be back in a moment to unpack the BOJ's dilemma and what it means for the global economy. Stay with us.
The Bank of Japan is truly in a tough spot. On one hand, they're seeing positive signs domestically, particularly in wage growth. The Wall Street Journal highlighted how major companies like Uniqlo and Suntory are offering substantial pay raises, which is a good sign for the overall economy.
That makes sense. A healthy job market and rising wages typically lead to increased consumer spending and economic growth. So why are they hesitant to raise interest rates?
The global uncertainty, primarily stemming from President Trump's unpredictable actions, is creating a lot of anxiety for the BOJ. They're concerned that a sudden move by Trump, like imposing those drastic new tariffs he keeps hinting at, could spook the markets and trigger a global panic.
So raising rates in that kind of environment could add fuel to the fire and make things even worse.
Exactly. Japan is a major player in the global economy, heavily reliant on exports. Any disruption to global trade could significantly impact their economic recovery.
Speaking of global trade and potential disruptions, CNBC reported that President Trump is also looking at ways to boost U.S. oil and gas production, which could have ripple effects on energy markets worldwide.
That's right. It's all part of his America First energy policy, which he emphasized in his inauguration speech. He wants the U.S. to be energy independent and is willing to use tariffs and other protectionist measures to achieve that goal.
But wouldn't slapping tariffs on Canadian crude, as Bloomberg mentioned, actually backfire and drive up oil prices in the U.S.?
That's the concern raised by a Commonwealth Bank analyst quoted in the CNBC article. Canada is the biggest oil supplier to the U.S., and their imports usually sell at a discount. If you add tariffs to the mix, the discount vanishes, and American consumers could end up paying more at the pump.
It seems like a classic case of unintended consequences. Trump wants to protect American jobs and industries, but might end up hurting American consumers in the process.
It's a difficult balancing act with a lot of unknowns, but one thing is certain: Trump's return to the White House has injected a huge dose of volatility into the markets.
It's definitely keeping investors on their toes. MarketWatch reported that some investors are relieved that Trump hasn't immediately imposed those sweeping global tariffs he threatened during his campaign.
There's definitely a sense of, it could have been worse among some. But Jim Reed from Deutsche Bank, quoted in the MarketWatch piece, offered a word of caution. He sees this threat of tariffs on Canada and Mexico as a serious red flag. It signals that Trump is ready to use tariffs aggressively, which could create a lot of uncertainty and disruption in the coming months.
It sounds like everyone's holding their breath, waiting to see what Trump's next move will be.
That's the reality of investing under a president like Trump. Adaptability and a willingness to adjust your strategies as the situation evolves are essential.
So what's the bottom line for our listeners? How should they be approaching their portfolios right now with all this uncertainty?
The most important thing is to stay informed and think critically about the information you're receiving.
Uh-huh.
Don't just react to headlines or follow the herd. Do your own research, consider multiple viewpoints, and make decisions that align with your financial goals and risk tolerance.
That's solid advice, and it reminds us that even in uncertain times, there are still opportunities to be found.
Absolutely. For example, the Barron's article about Roth conversions highlighted the potential benefits of taking advantage of the current low-tax environment.
Yeah.
They also mentioned converting assets when your IRA investments dip in value, something to consider if the market reacts negatively to Trump's actions.
Being proactive and strategic are key in this environment, and it's important to remember that the market landscape is constantly changing, and even expert predictions can be wrong.
Precisely, a well-diversified portfolio and a healthy dose of preparedness for the unexpected go a long way.
Well said. Now, we can't overlook the impact of Trump's policies on the tech industry. The Wall Street Journal had a really interesting article about how tech CEOs like Elon Musk, Mark Zuckerberg, and Jeff Bezos are all trying to get on Trump's good side.
It's a fascinating dynamic. These tech giants are often seen as liberal and have clashed with Trump in the past. But they're also savvy business leaders who understand the importance of maintaining good relationships with the government, regardless of who's in power.
It seems like they're willing to put their personal feelings aside to secure favorable policies and regulations for their companies.
The WSJ articles certainly suggest that many of these tech companies made generous donations to Trump's inauguration fund, likely hoping those contributions will buy them some influence.
It's a reminder that money talks, even in Washington.
Indeed, it will be interesting to see how this relationship between Trump and the tech industry unfolds over the next 4 years.
It's definitely something to keep an eye on, especially given how much influence technology has on our lives and the economy.
Absolutely. Now let's shift gears and talk about the UK. The Wall Street Journal reported that their job market is weakening, with unemployment rising and payroll jobs falling.
That's concerning, and this comes at a time when the Bank of England is already under pressure to cut interest rates to stimulate growth.
The WSJ article mentioned that some economists believe a rate cut is almost inevitable at the BOE's next meeting in February, but they're facing a dilemma. While they want to support the economy, they're also worried about rising wages potentially leading to higher inflation.
It's a tough balancing act.
It certainly is. This situation requires careful consideration and a nuanced approach. It highlights the challenges faced by central banks worldwide as they navigate an increasingly complex and interconnected global economy.
And if the UK is heading towards a death spiral, as Ray Dalio warned in his MarketWatch interview, then the BOE's job is about to get even tougher.
That's a sobering warning from a highly respected investor. It emphasizes the need for fiscal responsibility, especially with rising interest rates and governments already carrying heavy debt loads.
It's a stark reminder that the financial world is a complex ecosystem where everything is interconnected. Seemingly unrelated events, like a rate hike by the Bank of Japan, can ripple across the globe, affecting currency exchange rates and even the price of oil.
Exactly. Staying informed and keeping the bigger picture in mind is crucial in navigating these turbulent times.
Well said. And on that note, let's move on to some key takeaways and potential investment strategies for our listeners as they navigate this market roller coaster.
All right, so let's try to distill some wisdom from this whirlwind of market news. We've covered a lot of ground today.
Yeah, we have.
Buffett's cash hoard the bond versus cash debate, Trump's tariff bombshells, the Bank of Japan's rate hike dilemma.
It's enough to make your head spin. But amidst all the noise, are there any clear takeaways for investors?
Absolutely. Let's start with the big one. Trump 2.0. What's the overarching message for investors trying to decipher his moves?
That's the million-dollar question, isn't it?
I think the key is to understand that his economic policies are driven by a few core principles.
Okay.
First, he's a protectionist. He wants to protect American jobs and industries, even if it means disrupting global trade and potentially sparking trade wars.
Right. We're already seeing that with the tariff threats on Canada and Mexico.
Exactly.
Yeah.
Second, he's a believer in deregulation and tax cuts. He thinks these will boost economic growth, but critics argue they'll also increase inequality and the deficit.
So there's a lot of debate about the long-term consequences of his policies.
There is. And third, and perhaps most importantly, he's unpredictable.
Oh, yeah.
He often makes decisions based on gut instinct and can change course quickly.
That makes it really tough for investors to plan ahead. So what's the best way to navigate this uncertainty?
I think the key is to stay flexible and don't overreact to every headline. It's important to have a long-term investment strategy and to stick to it even when the market gets choppy.
Speaking of long-term strategies, you mentioned the whole bonds versus cash debate earlier. Barron's presented some compelling arguments on both sides. What are your thoughts?
It really comes down to your individual circumstances and risk tolerance.
Yeah.
If you have short-term needs like saving for a down payment or an emergency fund, cash is the safest bet.
Shent.
For longer-term goals like retirement, a mix of stocks and bonds has historically been a solid approach. But given the current uncertainty, some experts like William Bernstein are advocating for a mix of stocks and cash, at least for those still working.
So there's no easy answer. It's a judgment call.
Precisely. And it's important to consult with a trusted financial advisor to determine what's right for you.
And what about Roth conversions? Is now the time to make the leap?
Again, it depends.
Yep.
If you believe that taxes will be higher in the future, converting to a Roth IRA now could save you money in the long run.
Okay.
But there are other factors to consider, like your current income, your retirement goals, and your overall tax situation.
So yet another decision that requires careful consideration.
Absolutely. But the good news is that you have options, and you can tailor your investment strategy to fit your unique circumstances.
And speaking of options, let's not forget about the Bank of Japan.
Hmm.
What should investors be watching for as they grapple with the potential rate hike?
Keep an eye on the yen. If the BOJ decides to raise rates, the yen is likely to strengthen, which could impact Japanese exporters and the global economy. But as we discussed, the BOJ is also very sensitive to external factors like Trump's policies and global market sentiment. So any unexpected moves by Trump could throw a wrench in their plans.
It's a reminder that the financial world is interconnected and that events in one part of the world can have ripple effects everywhere.
Exactly. And that's why it's so important to stay informed and to be aware of the bigger picture.
Well, I think we've covered just about everything for today. It's been a jam-packed deep dive.
It has.
But hopefully our listeners feel better equipped to navigate the market roller coaster.
I hope so too. Remember, knowledge is power, especially when it comes to your finances.
Well said.
Yeah.
And as always, we encourage you to do your own research, seek professional advice when needed, and make investment decisions that align with your goals and risk tolerance. Be sure to tune in tomorrow morning for a fresh batch of financial headlines from major financial magazines.